defined risk spread with tips is a parlay on the segment we did Friday with Kai, kind of highlighting why wider spreads have a better win rate, have a better profitability projection or expectation, why the max loss, the probability of reaching max loss is significantly higher the more narrow your spread is, just because there's not much room between the short and long option for credit spreads. So we're going to take that a bit further today with some defined risk tips for y'all.
For sure. A very common question we get all the time. All right, so first we'll just talk quickly through the entry the tips that we got here. So in reference to increasing contracts versus widening of the spreads, it almost always makes sense to widen the spreads versus increase the contracts. And we'll look at a couple visuals that we have that I pulled from the market measure from Friday that kind of support this idea and show this, in terms of risk as well as time in the trade. So for the most part, when you look at widening out spreads versus upping the contracts, the max profit is going to be generally very similar, right? So you're not going to, we know that as you get further out on the tail, the premium and extrinsic value will get lesser. So there is going to be a lesser total value, but it's a small amount relative to the things that go in your favor, which are, much lower probability of realizing max loss, much faster moving positions, a less volatile P&L on those positions, especially when you get closer to expiration. But for all intents and purposes, when you are selling at 30 delta, short option, and you go from a $1 to a $5 wide spread, the relative value is going to be very, very similar compared to upping the $1 wide contract size, going to 5 contracts there. So it is going to be a little bit less, but it's going to be relatively very similar. You got to keep in mind the max loss and where that occurs rather than the actual amount, right? So with spread trades, it's not necessarily the loss that matters, the actual value of the loss. It's what probability do you have of realizing that max loss, and where does it occur? When you have 10 contracts of a $1 wide spread that has, say, $500 of risk on it, that risk is much closer to the stock price, which means that it's a much higher probability of happening versus one $10 wide spread where the risk requires the stock to move $10 more to get to that same $500 in risk. So keep in mind where your risk is, and also the fact that wider spreads are going to have a much more variable profit or loss. When you have tight spreads, it's very binary in that you probably realize the full max profit or the full max loss on 90% of the trades, whereas with wider spreads, you have that variable profit and loss zone where a trade that you did, a $1 wide would have been a full loss, right? So you got to keep in mind that variable is really, really important, and it helps flatten out your P&L distribution over a large number of occurrences. The one thing I will say about wide spreads versus upping the contracts is you do have to keep in mind the actual long option value, and you could use delta or the actual value of the option. In certain cases, if you're moving from a 5 delta option, and this represents something that's outside the one standard deviation. When you're looking at a 5 delta option, you're moving it another couple strikes out of the money. The relative difference in extrinsic value is negligible, right? So in that case, we might just up the contracts just because you're not moving further out on the curve. When you're moving from a 25 delta long option to a now 16 delta long option, that's the case where we would widen out the spread and get a little bit wider on those positions versus increasing the contracts. And that's all because of the relative delta of the option, the relative value change when you're moving further out on the curve from those tail options. It makes more sense to up those contracts versus widen the spreads. Widen the spreads when you're at closer at the money, like inside that one standard deviation range.
Yeah. And really the only exception to where more contracts versus widening would apply as if you're trading, smaller price stocks. If you're trading like Apple or Microsoft, it's probably still going to make more sense to go wider. But at the end of the day, I think the most important thing to consider is just that when you have a narrow spread, like a 1 point wide, 2 point wide spread, if it's a loser, it's probably going to be a max loser if it's near expiration, because you don't have a lot of space. If it's a 5 point wide, 10 point wide, 15 point wide, 20 point wide spread, it's going to be much harder for you to realize max loss just because you need the stock to go that much further. So I think that's the biggest thing to consider when it comes to spread width and kind of balancing spread width with your risk tolerance.
All right, some bad habits to avoid. So spread value versus strategy is one thing that we consider. We don't want to just sell junk, right? We don't want to, like, if you're looking at an iron condor and your call side is very, very cheap relative to the put side, just do the put spread. Like, you don't have to make a strategy into an iron condor just to say it's not an iron condor. Keep in mind that, you want to ask yourself the question, would I want to sell this to open? Do I want to keep this risk on for X amount of value that's left on the table? You got to make sure that if you're going to sell premium, it makes sense to sell that amount of value and keep that position on and keep that risk on. Of course, closing out of losing spreads. So a lot of times we'll get questions of like, I did this iron condor and now the stock is lower. Should I just get out of my short put spread? And the doing that sort of adjustment and closing out of a portion of the position, especially if it happens quickly, is going to end up being like a death by paper cuts. You're just going to have a lot of small losses, and a lot of those small losses will turn into potential winners down the line with time decay and changes in volatility and maybe price action working in your favor. So, avoid the death by paper cuts. You got to put your trade on at 40 days to go till expiration. You got to expect to be in it for 20 or 30 days, especially with tighter spreads, your $1s and $2s and $5 wide spreads. You got to hold those. They're not going to be fast moving trades for or against you. And so you don't want to overmanage yourself there, which is the next point here. Being too aggressive with management. We talk about it all the time of just keeping in mind the spot that you have to hit with a spread trade, especially one that you're trading on both sides of the market, your iron condors, iron flies, stuff like that. When you get to a very narrow price range that you have to hit, it's going to be very, very low probability of hitting that spot, as well as the fact that you'll be in that trade for a much longer period of time. Sometimes with spread trades, you got to kind of ebb and flow with the price action of the market. You have to take a little bit of long delta into down moves. You have to take a little bit of short delta into up moves. And that comes with the fact that your position is defined risk on entry. You have to be comfortable with that risk. You have to be able to hold it. So another point to make, inverted spreads. So you unfortunately with iron condors or with spread trades, the management is relatively limited. There's not a whole lot you can do with strangle trades. You can do a lot. You can roll out in time, move your strikes, move further out of the money if you wanted to. There's a lot of flexibility there. With spread trades, you don't have that. If you go inverted on a spread trade, meaning your short call spread is at a lower strike relative to your short put spread, those spreads are inverted. You can potentially lose on both those spreads. You'll be using more capital as well. So you got to just keep that in mind. Also, overthinking. So this goes to like the idea of closing out losing spreads. A lot of people want to close out the winner, right? So you have a short put spread, stock drops, and we'll get the question of like, oh, should I just close out of this long option because it's gained X amount of value? And the problem with doing that is you totally flip change the risk profile in the position. You go from a spread trade that might have $200 in max risk to now a naked put that has, a lot more risk. It uses a lot more capital. If you're thinking about doing that, you should probably just be getting into the short put on entry. Like, it's very hard to kind of play both sides. You'll miss out on the upside if you're directionally correct as opposed to directionally wrong. So just keep that in mind. Spread trades, you can't overthink them. They're slower moving trades. You got to kind of put them on and let them play out and see what happens with those. And I referenced the market measure there in the bottom. So that's from Friday, it's called The Problems with Trading Tight Iron Condors. It's in the tastylive.com archive, so you can check those out. That's where I'm pulling these two charts, which I think are the two most important points in the market measure. So the first point being the volatility of P&L with tight spreads, right? So as you get long, you've been in the trade your 30 days, which is what you should expect to be in these trades. You can see as you go from 30 to the end, which is 45 days, the volatility of your P&L and the tighter spreads gets much, much greater. Now, assume that for all these positions, we're putting the same amount of risk on. So $1 wide, we'll do 10 contracts. $5 wide, we'll do 2 contracts. $10 wide, we'll do 1 contract, and then obviously the strangle there just is much less volatile than all 3 of these, but we'll just look at the spread specifically. When you get from that 30 to 45 days, the volatility of your P&L becomes more binary, right? With the $1 wide spreads, it's either full, or in a lot of the cases, it's a full profit or it's a full loss. That's why that P&L value dips so significantly, because you have no variable loss. It's all or nothing on those trades. Whereas when you get wider with those spreads, it's a much less volatile P&L. It does come down as you get closer to expiration, because we know, and the reason why we manage positions is because you can only make so much and you can lose that full value plus the profits on the table. So as you get closer to expiration, all strategies will have a much more volatile P&L. But you can see with the wider spreads, it's significantly less volatile than the $1 wide spreads, which is why we tend to widen those spreads versus increase contracts. Mm-hmm. All right, then the second one, the duration of the trades. This is something that people don't necessarily think about. They kind of lean first towards how much can I make, how much can I lose, but also think about the opportunity cost of capital, especially if you have limited capital, and we all have some sort of limit. So everybody has to apply this into their trading, but tighter spreads will take much longer to reach, specific profit targets. 50% is what we're looking at in this segment, which means we can't cycle through that capital as fast and redeploy it and use those profits, redeploy those profits into new opportunities. When you look at these spread trades, and it might not seem like a lot, but when you're doing this 10 times a year, right, and your $20 wide is getting to profits, 4 or 5 days faster than your $1 wides. When you do that 10 times, that's 50 days. That's 20% of your trading year, 252 days of market days per year. If you're getting 5 days less and you're doing that 10 times, that's a lot of that's another round of occurrences. So you have to keep in mind that with these tighter spreads and versus wider spreads, you're going to have relatively the same metrics from max profit and max loss, but you're going to be in those trades, the $1 wides, much, much longer, and not be able to, cycle through that position as many times.
Yep. And sometimes we get this question of, how do I know relatively based on the stock price if my spread is narrow or wide? Because a 5-point wide spread on a $50 stock is going to be a wide spread, but a 5-point wide spread on a $500 stock is going to be very narrow. So the one thing you can do is just look at the difference in value of your short option that you're selling versus the long option that you're buying to protect your risk in the case of a credit spread. You could also look at the delta. Is the delta very different between the short and long, or is it the same or similar? If you have a 5-point wide spread in Tesla, it's going to be very similar. But if you have a 5-point wide spread in like US Steel, it's going to be very different. So just keeping in mind that relatively wide or narrow can be defined as just looking at how big the difference or how little the difference is between your short and long option.